Hi there and welcome to the guide on logbook loans. So just as secured loans, often referred to as second mortgages or second charges, are guaranteed by a borrower's home, logbook loans are secured on a borrower's vehicle, so be that a car, a van or a motorbike. This means that the lender owns the borrower's vehicle until the loan is fully repaid, although he or she can continue to use the vehicle in the meantime. And when the loan is fully repaid, the borrower owns the vehicle again. The maximum loan amount available varies considerably between the lenders, but in all cases will be limited by the market value of the vehicle. The amount available varies between £200 and £75,000, according to what the vehicle is worth, and generally lenders will lend between 50 and 100% of its value. So how exactly does a logbook loan work? Although there is not a credit check for a logbook loan, a lender will assess a borrower on affordability criteria. It will also want to examine the vehicle that is being put forward as security, either at one of its branches or during a home visit. When you're accepted for a logbook loan, the lender will take possession of your vehicle's logbook or V5. That's the document which names you as the registered keeper of the vehicle. As well as signing the usual credit agreement, the borrower will also have to sign a bill of sale form. This transfers the ownership of the vehicle to the lender on a temporary basis. This does not affect who uses the vehicle or a borrower's insurance, and he or she can continue to drive it as normal as long as the repayment schedule is adhered to. Bill of sale documents are legally binding in England, Wales and Northern Ireland, although they are not used in Scotland. Like other forms of credit, should you fail to keep up with repayments, you'll be served with a default notice by the lender, which will give you a chance to put the matter right. If you fail to satisfy the default notice, then the lender will be able to take possession of your vehicle and sell it to cover the outstanding loan. A bill of sale is only legally binding if it is registered with the High Court, so a lender will have to apply to another court to take possession of the vehicle if it is not. However, it should be noted that most logbook loan lenders automatically register bills of sale with the High Court. So you're probably wondering, why should I apply for a logbook loan? If you need to borrow a large amount of money but are having difficulty obtaining the traditional forms of finance, then a logbook loan may be worth considering. Interest rates are generally much lower than payday or instalment loans, typically around 300 to 400% APR. And the loans are repayable in instalments over 6 to 18 months, and there are no credit checks for a logbook loan. But the borrower will still have to demonstrate to the lender that he or she can afford the repayments and provide evidence of both income and outgoings. Assuming that you don't have outstanding finance on the vehicle that you want to use as security against the loan, you should be able to apply for a logbook loan. Even in cases where there is some outstanding finance on the vehicle, some lenders will still consider a logbook loan providing that the borrower can get permission from the existing finance company. So what are the downsides of a logbook loan? The biggest risk with a logbook loan is potentially losing what might be your only means of transport if you do not keep up with the scheduled repayments. Lenders have the legal right to use bailiffs to seize your vehicle if you default on your loan, although most will give you a chance to catch up before resorting to such a measure. You should be aware that provided a bill of sale is registered with the High Court, a lender will not have to go through any further legal procedure before taking possession of your vehicle. So even if a lender sells your car, it can still apply to a court to recover this money. In conclusion, a logbook loan may be a viable way of gaining finance if you are unable to raise money another way, so as long as you have a vehicle of sufficient value to cover your borrowing. Remember that your vehicle is security and you risk losing it if you default on your debt.